Let's take a quick look at our own markets this Wednesday and see how the Philippine Stock Exchange is open today. Looks like it's a slightly higher open at 6,420, up about 0.1%. PSCI gained yesterday, Tuesday, by nearly 1%, with all the counters in the green except for financials. Meanwhile, the Philippine peso opens today slightly weaker, 55.80 to the dollar. Peso closed yesterday a tad weaker at 55.721 against the greenback. Well, with us now for more is Peter Garnace, the Equity Research Analyst at Unicapital Securities. Welcome back to the program, Peter. Thank you for joining us.
Thanks, Kathy, for having us.
So it looks like the disinflation trend is still very much intact, and that's what you're looking at in terms of markets.
Correct. Yes, we think that inflation is still on a disinflationary path right now, and this is driven by three factors, we think. First would be the rice prices. We think that rice prices would continue to go down. If we take a look at the April inflation, rice prices back then had a deflation. That means that a negative growth of around 11%. And then the second factor is in terms of transport. So we are also thinking that there will be a deflation in the transport, especially that fuel. We have seen fuel prices, especially the global oil prices, have also come down. If we can recall, last year, fuel prices was around $80 a barrel. Now it's hovering around $60 a barrel. So that's most likely gonna bring down inflation as well. And then the last point would be the peso appreciation. So year-to-date, peso has appreciated by around 4%. So it's strongest since 2023. And we think that this will also ease down the import inflation that we are experiencing as well.
So you get a bang out of your buck if, for instance, you want to travel overseas, you can spend a little more because the dollar is so weak. But then I'm looking at inflation in a more cumulative basis. If you take a look at the accumulation of inflation over the COVID pandemic, then you might want to rethink, are consumers really spending because they're seeing these inflationary numbers go down? Because they're still being affected and feeling the after effects of cumulative inflation from 3 years ago.
Right. If we take a look at the data on inflation in the past 2 to 3 years, I think it's around 15 to 20% cumulative inflation. And it is actually, yes, you're correct, it's affecting the household balance sheet. But if we take a look at the first quarter GDP, the household spending grew by around 5.3%. And it's actually one of the strongest in the past few quarters. And this means that our consumers are really resilient. The household spending is resilient. So there's dry powder in our consumers.
And also maybe more to stock up, more money to stock up on the basic goods. But if you're, let's say, trying to buy a condo, maybe a house, and you know that mortgage rates might go lower with the Bangko Sentral cutting rates further, then that consumer might want to just take a step back and say, I'm going to wait. And I'm not going to spend right now on a new home or a new condo.
Right. It's also good to wait for when the interest rates are going to bottom out for our consumers to buy, let's say, for example, big ticket spending, for example, the condominiums. So it's also okay to wait.
Okay to wait, but it's not good for the economy, though. I mean, you know, there's no movement there. So this wait-and-see game also seen in the property sector.
It's a wait and see for the property sector, yeah.
Right, which brings us to the interest rate outlook then for the Bangko Sentral. Seeing that, yes, there is this inflation, how much of a rate cut then is the Bangko Sentral going to make in view of how the Federal Reserve moves? Because it also has to watch that interest rate differential.
Right. Our expectations for the second half of 2025 would be around 50 bips rate cut for the BSP. It may happen in June, it may not happen in June.
Why not?
Given the uncertainties globally, the lingering effects of trade war, I think BSP would be stay measured, calibrated in terms of their policy easing, given the potential inflationary pressure of the Trump tariffs. Although, of course, they have the room to cut rates because our peso right now is the strongest since 2023. So they have room to cut interest rates. But in terms of the timing, that we aren't sure yet.
Will the markets be happy with that if they don't move on June 19?
Well, I think right now the market is pricing in an interest rate cut, 25 bips by June.
So they wouldn't be happy if the Bangko Central did not move on June 19.
Most likely, yes. But in terms of inflation, inflation is on a downtrend, as we've mentioned. So market would still be, happy. They're still expecting sooner or later the Bangko Central ng Pilipinas would cut interest rates.
Yeah, well, what's happy these days in the markets? Because there's a lot of like wait and see. I mean, I've just had Japheth Antiangca yesterday of PhilStocks Financial saying it's a wait and see.
Right.
At a time we're looking at this financial year where, second half, people just buy equities.
Yeah. So
down to Christmas. So it's a better picture out there, whatever happens.
Right. So despite the risks, despite the threats that we're seeing amid the trade war uncertainties, we think that there are silver linings in the stock market. We are thinking of the yield-sensitive stocks to recover, as well as the dividend stocks to also be attractive right now. If you take a look at the yield of our REIT stocks, you can lock it in at around 6 to 7% right now, and also our dividend plays. You have the utilities, you have the telco stocks, you have PLDT, Meralco, or you have also Manila Water. They're giving attractive dividend yield right now.
So if, for instance, an investor got into those dividend yield and high-yielding stocks, how much would they have earned in the first 6 months this year?
Well, yeah, I think as mentioned, the yield is around 6 to 7%. For PLDT, for instance, they're giving around 8%. So I think that's the highest for the utilities and the telco sector. So 8% yield.
Okay, another way to slice and dice the uncertainty there, the wait and see. Park your money into dividend and the high-yielding stocks. Well, thank you so much for joining us, Peter. Appreciate the insights. Peter Garnace of Unicapital Securities.